Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today we've got Andrew Watson. He's the CEO and co-founder of Cabbage Analytics. Andrew, thanks for being on the podcast.
Thanks for having me.
So it looks like you've got some data analytics already up on the screen. Tell me about what we're looking at right here.
Yeah, so we have Cabbage Analytics. We work with a lot of retailers and delivery services across San Francisco Bay Area. And we've been doing a lot recently, poking into the data and looking at what happened really after the shelter in place, which was enacted on March 16th, with delivery and retail and the trade-offs specifically there. And so you see the dots flying around on my screen right now. What this is an example of is for a specific anonymized retailer in San Francisco itself. Before the lockdown, they basically 75% of all their orders were in-store orders, people coming into the store, purchasing with a bud tender, and about 25% of them were delivery orders, right? So they go online, place an order, car comes and drops it off.
Sorry to interrupt, but how many of those orders were pre-orders, so ordered online, but intended for either pickup? Obviously, you can't pay for it in advance, but how many were pre-orders?
I would say of the in-store orders, we're talking 5% are pre-ordered. The vast majority before the lockdown was really, I'm ordering delivery now on my phone now, or I'm walking into the store and I'm buying it now. We weren't really seeing a lot of order ahead activity before the lockdown. Since the lockdown, all of the retail orders that you are seeing, and you can see how it drops to retail, basically flips to below 50% of their entire volume, are pre-order. And so, really basically the day of the lockdown, there was a massive operational change where all of a sudden can't go into the store, have to go online to pre-order, and really try to drive as many people as possible to actually use delivery. And so with this customer, we help them move a lot of messaging because our tooling lets you actually target SMS messages to people who are like in San Francisco, have only ordered retail. And we were able to actually successfully move this business's entire business almost overnight into a really delivery and pre-order operation. And they've actually been very successful in weathering the storm because of that, including expanding the delivery service beyond San Francisco as of yesterday.
Explain that to our viewers. We've got some people in Serbia and Vietnam and all over the world, all over the country and I myself don't remember if California always had delivery. So is this a service that's always been available? It's just been expanded?
Yeah. So, in this, I'll pop into another kind of quick chart right here where you can actually see the city of San Francisco and delivery orders throughout SF over time. In California, the way it works is pretty much every person who has a license to distribute recreational or sell recreational marijuana also has the license to deliver it. In fact, in California, about half of all recreational licenses are recreational non-storefront, meaning that they're exclusively delivery. They're out of a warehouse. They only do delivery. This was from the beginning of California. There were medical marijuana delivery services that were very prominent. I think Ease, if you've ever heard of them. And so when they brought on recreational marijuana in January 2018, they basically brought over the legacy mix. And so now you have all of this delivery that is available. So if I have a store, let's say Joe's Pot Shop down the street, and I go to that store, I can also, if I want, call the store and have them drive and hand me my cannabis in a brown paper bag. Basically, I pay in cash or I'll pay with card online. Yeah.
So consumer behavior is easy to see because it's mandated. So that previous graph you showed 100% change in the way that people were purchasing before, whereas 25% were online orders. It went up to 75%. I'm not sure how that's not 100, but essentially that's 100% difference. And so I'm curious with the way that consumer behavior as it pertains to cannabis in the future, is that going to be long-term? Are people going to want that convenience factor of online coupled with, the benefits or the discounts for that online order? Is this long-term?
Yeah. So what I've seen with a lot of my customers, even before the lockdown, was an overall trend towards delivery or an overall need for places to have a competitive delivery offering. If you're a four-wall retailer and you're not in a very key trafficked segment of town, right? You're like right next to a public transportation stop, right off a major highway. You're competing with the fact that anybody can go online and Google, cannabis near me, and the first thing that'll show up is a delivery service that can just bring it to their house. And so, it's really important, I've always found, for these retailers to, if they have the offering, to be competitive with that. I do think that the only thing really preventing, to your point, a much larger percentage of the population using delivery now is they don't know about it. We're used to thinking of our food being delivered. We're used to thinking of our Amazon orders being delivered. We're not used to thinking of our cannabis being delivered. And so that's where, I really think that consumers, with the revelation that that can occur, will, I believe, move more towards delivery. And what we have seen with the lockdown is effectively what would happen over the course of 2 years happening over the course of 2 days.
Mm-hmm.
And I think other states are going to see the success that California cannabis will have in weathering the storm because they have delivery, and realize that, they're missing out on tax revenues. They're missing out on the ability for people to receive their essential cannabis because they're not offering delivery. And I think that we're going to see that change in other states as well.
A lot's been changing. Just Zoom, we're using Zoom right now to talk, and so looking at the net worth of Zoom is now worth more than American Airlines and some other stocks combined, as some sectors are going down and others are coming up. I think cannabis will see that inverse relationship eventually. But I'm curious, before we get into like consumer preferences and what they're actually having delivered, I kind of want to talk to you about the difference between edibles and a most popular category of flower and combusting. But before we get to that, I want to touch on delivery. You mentioned Ease. That's a Snoop Dogg investment. They had I think got a little over $160 million in investment to start a delivery service. They didn't do very well, and so now they've kind of started their own brick and mortar, competing against the very companies that they were collecting money from, which is it's interesting where they went out, they were able to get all of the data, all of the information, and then compete against those people. And so I'm curious, you can't have drop shipping, right? But you can have delivery. So how is this all working out
in terms of how delivery operators are able to basically compete or gain market share?
Yeah, let me collect my thoughts a little bit, because there's like 3 different things in there. So I kind of want to know a little bit about like how Ease failed and what they're doing now to add delivery, and also where is drop shipping going to play a role in the future of cannabis, with California having a massive real estate from Redding at the Emerald Triangle all the way down to San Diego. There's a lot of real estate in there. How do you get delivery to the customers? Do you have to have drop shipping eventually? What's the most efficient way?
Mm-hmm.
Where do you see the industry moving? So I'd like to know a little bit about drop shipping and delivery options in the future. But initially, I'd like to know what the hell happened to Ease and delivery?
Yeah. So, I could talk about it almost, as a data person, I'm always hesitant to talk anecdote, but I can talk about it a little bit anecdotally, my own personal experience and how it plays out, I think, in the data.
I'm going to ask you to infer a lot of stuff, so we have to pull that out and guess what this data is saying. So, yeah, if you don't mind.
Yeah. So through both the data of my customers that I work with who are delivery, and through just like knowing the experience of what's been happening, I think where Ease failed is that Ease didn't actually have a competitive advantage. There is an assumption that, you're a technology that you can deliver cannabis, you must have a competitive advantage. But again, all storefronts are also delivery services. There is no reason why any store that is using Ease to deliver their products can't deliver it themselves. And if Ease is causing a markup of the product, and 280E, IRS tax code 280E, which, if your listeners don't know, basically means that cannabis businesses have to pay tax. They can't deduct operational costs from their taxes. So they basically have to pay significantly more taxes to the federal government than a normal business. Because of that, there's not a lot of margin at the end of the day. And so if Ease sits as a software provider at the end of the chain and tries to ink the last dollar of margin available in a whole process in which there is no margin, all they're going to do is create an incentive for businesses to figure out how to replace them and keep the margin for themselves. And so that's what happened, right? Think Caliva. Caliva is now a huge operation in the Bay Area, massive vertically integrated delivery and product line. They were birthed underneath the hood of Ease, and they just decided to do it themselves, right? And by doing it themselves, they have all the customers because they have all of data, because in the end, all of the customer transaction information is Caliva's, it's not Ease's. They know the Bay Area, they know how to market weed maps, they know all the stores to put the products into. All they have to do is say, hey, Ease, we're going to keep that extra dollar for ourselves, whip up a simple website, whip up a simple delivery, logistics platform, which is not hard, and just do it themselves. And now what can Ease do? They don't have the products themselves, and they're asking again to be an last mile cost layer when people don't need to inherit it. And that's where I think it ultimately crumbled, is that basically people who were doing well underneath them spun off and did it themselves. They were able to keep the costs. They were able to bring that and reinvest it back to their businesses to make better products. These product offering drops off, and then their delivery times go up. And so they were just not able to give a service that is any better than, getting a Spark or a Basa or a Caliva or a Sava to deliver the cannabis. And those are actual cannabis operations. They're not just software.
I guess I'm so curious where the hell the $160 million went. Did it take them that much to figure out how to do a simple online delivery app? I mean, I could have done that for 10 grand. I'm not going to ask you to answer that if you don't want to, but I'm curious where the hell the money's at.
I will say, I'm not deep into their P&L, so I don't know. I will say though, I like to say this, in my experience in the past, I used to work at Salesforce, running budgets, very large, multi-million, $100 million budgets. And whenever a team came to me and asked me to hire a team of data scientists, and I am a data scientist myself, so I understand this. If you're going to pay $1 million a year for a team of data scientists, they better invent over $1 million worth of profit to pay for themselves. And so if you're spending a lot of money on technology development in a world in which there's very little margin to begin with, all of that needs to reap returns quickly. And I think that that's what they did. They played the long game, and there wasn't time to play it. The market was too volatile.
Mm. Yeah, I mean, that's interesting in and of itself. You kind of have to plan for the unplanned and pivot to stay relevant. So if you've got a long-term plan, you better have like 12 different pivots within that just to stay relevant for sure. And I'm sure you're seeing that right now. I bet you data is just kind of jumping off left and right. I don't want to hijack what you've got here, but I'm curious if there's anything in here that we can point to that's going to give us an idea of what is being consumed. My guess is that you're going to see a lot more edibles, a lot less of consumption of flower. And I don't know how to judge that, because you're going to see the sales of bulk flower in ounces or large quantities, but I don't think that people are actually consuming that. I think they're storing that away in the eventuality that maybe something like Ontario that temporarily closed the stores before opening them back up again. If we see that reversal of essential businesses, that at least people have that stockpile. But I think they're going towards non-combustible forms. Do you have any data to support that?
Yeah, so actually, let me open up into this. And so this is across same data set. This is several customers of mine who all sort of, they opt in to let us use the data to analyze, figure out what's going on in the market to help build out some strategy. This is a share of just total overall orders. And this is essentially by different product category, right? How many orders. And so you can see before the lockdown, and this is also very true of delivery in general. And actually, I would skip one slide and show you ticket size. So on average, an in-store ticket, right? On average, when someone goes into a store and buys something, they spend about $50 to $60. When they get something delivered, they spend about $120. So they normally get delivered on average twice as much. And so you'd say, well, that means that they're not ordering as frequently. not actually true. What I see is that there's actually very little difference in frequency of usage across customers who are exclusively retail versus exclusively delivery, except for regular pre-roll shoppers in retail. Those shoppers do order very frequently. But so with delivery, and this is again why delivery I think is also a huge opportunity, people are ordering twice as much and they're ordering it just as often. And so what are they paying for that twice as much? And go back to the crowded category, they're generally to that point buying a lot of flour, more flour than we see in a retail operation. They're buying ounces of flour, quarters of flour, bulk flour, to your point. A lot of this is propped up because a lot of people do have delivery minimums on the orders of like $50, $60. But when the lockdown was actually coming towards this, what we actually saw was a trend away from flour up to this point, and actually growth in concentrate and vapes. Now, a lot of this was, I think, to do with actually recovery from the vape crisis that happened previous year. We were seeing a somewhat natural recovery of the vape crisis that was happening, I think, before all of a sudden everything kind of blew up. And that's sort of why you're seeing a steady decline here of the flour as a total share. Lockdown happens. We don't really see a massive volatile spike in any one direction, except for lagging increase of edibles post-lockdown. And I do think overall, and this hasn't totally materialized into April, but I do think long-term, we actually are going to observe a migration to edibles. And I think that has to do with the fact that consumers being at home have the actual ability to sit down and consume edibles and more often, potentially, and have more time to deal with the onset of the effects and the lag of the effects, right, than they would necessarily have with combustion, which is more of like a go on the go sort of type of mentality. However, overall, I am not seeing any like massive, the way that we saw that huge flip in the way that people were ordering, I'm not seeing as massive of a flip in what they're ordering when it comes to delivery.
I thought pre-rolls would be a lot lower because pre-rolls are a social tool. You know, the puff puff pass has kind of not been around for about the last month. And to my understanding, it's white women 50 and over that were the number one demographic buying them. Maybe they're not going to the stores. Maybe it's combustion issues or concerns, or maybe it's just that they're buying other stuff. It doesn't look like your data for San Francisco was maybe as hit as hard as other regions.
And I think part of this is also due to the delivery, the way that people engineer delivery deals. They do throw in a pre-roll a lot, or a pre-roll is how you hit the delivery minimum. So I think there's some of this is the architecture of how like the standard market practices for what you're offering on the menu. And I think that that's what you're seeing happening is people are throwing in the pre-roll. I don't think it's necessarily showing, to your point, a preference for people moving to pre-roll necessarily. I think that's more of an artifact of the way that deals are structured on the delivery menus.
Do you know, or can you say one way or another if San Francisco is more medically inclined with their purchases as opposed to LA that seems to be purchasing more to get high or inebriated, if you will? Can you see the difference in what people are buying to get certain effects?
So I can see the difference in purely who's buying medical versus who's buying recreational, right? And I can tell you that medical fell off a cliff after rec came in, and when it was, 100% the day before, within a year, you're talking fractional percentage points.
Right.
Now, but it's because the barrier to entry of getting a medical card doesn't exist. The same people could still be choosing to consume it medically, to your point.
Mm-hmm.
The way that I see it, and I don't have it explicitly on this graphic because it's actually a very small share, is actually the starting rise of topicals and balms and high CBD, and the rise of actually CBD-based product usage, I think is the most highest indication of maybe a shift to medical. However, I am still seeing dominant shares of what you would probably consider recreational products and movement towards recreational products. But that doesn't mean that there isn't being an expansion. I'm just not seeing it as much.
Back to delivery, I'm wondering if you've seen anything comparable with another industry, Grubhub or Uber Eats. Do you know if there's any other um, analytics that we can point to show that delivery equates to more consumption? If you go to a restaurant, you're going to eat less than delivery. I mean, is it, can you compare that? Because what you're telling me is that there's a 2 to 3 times the amount of products that people are ordering, and it's not less frequent. It's just they're just ordering more. Now, is it because of COVID? Is it because they just have that ability to try different stuff because they're at home now, or or is this just an industry exception and you can't compare that to food delivery?
So I'm actually, I think it's very intriguing. I don't have any relevant related data on the food side. I would be really curious. I could see it going both ways. I do know that, again, part of this is due to how people engineer menus, delivery minimums, right? That's a key thing. And the key thing is whether or not you've created a delivery minimum that is at the ticket size of your retail ticket, naturally you're going to force everybody up. Right? Now, beforehand, you could explain that by saying, well, if only 25% of my overall sales were from my delivery arm, then that explains. Basically, you put a $60 delivery minimum. You knew my average ticket size was 60, which means everybody needs to be 60 or more in delivery, which means my heavy consumers chose to go to delivery, and the people who aren't willing to buy 60 or more, they migrate to in-store, right? And so you have some natural shifting. In this day and age, what we're dealing with now, in which you can't go into the store at all, I'm feeling as if, though, people didn't drop that. And so basically what is happening is it's a kind of a compounding effect of people who used to go into the store and buy less now are shifting to delivery for the first time, seeing that they have to have a delivery minimum and choosing whether or not to purchase at all or just purchase more in bulk. And they're then purchasing more in bulk. Right. And so that's why if you look at this graphic here, you can see this is average ticket size before and after. Despite a large shift to delivery, we didn't see a modification in the average size of their orders. Now, the question then becomes, do all those people who used to only order retail, who are now ordering delivery, are they going to change their frequency? Because I mentioned beforehand, I'm not seeing a difference in frequency. I don't have enough data yet to suggest any change in frequency so far. But what we might observe is that, right, is that there is the population of people who are used to smaller ticket size, who are only retail, who are now delivery, and they're going to start ordering less frequently because of that. That makes sense.
It does. So you said there's a minimum order or at least some kind of incentive to get people to order more. Is that on a point system? Because I've got this burger joint down the street and they only charge like $8 for, a burger and fries, and it's deluxe and it's really good. And, can't compare that to McDonald's. But they have a point system. So, if you go there a few times and you can get free fries or you can save your points until you can get the full free meal. Is there a comparison to that in the cannabis industry? I just got a text alert that said 30% off all quarters. So quarter 30 is a discount code you can use. Now that wasn't going to entice me, but when concentrates go on sale 30%, people flock there. Now I did go with when it was 55% off exclusive brands. That got me. I'm like, okay, let's go. Time to go to the store. And so Washington doesn't have delivery, so I have to go and pre-order. And then there's tape outside 6 feet across, so you have to wait. They take your ID, you pay, and you're out. So there is some kind of incentivization with discount codes. How prevalent is that in California, and does it work?
It is very prevalent. And then actually the software that I create and sell to retailers, one large thing that we do is we basically enable them to, when they have these deals, right? So for example, you talked about the quarter, the 30% off quarter. A lot of times what that works is that the brand will come, let's say that brand is, coming out with one like Flocana, right? Let's say Flocana, California, major California flower brand, goes to the store and they basically say, hey, we want to drive volume for you. We're willing to let you we'll cover 15% of a discount. And the store says, okay, we'll match that. We'll cover another 15%. We'll do 30. So the store just knows that they have this amount of stock, a supply of Flocana, and they know Flocana is covering half the discount. And so they're saying, okay, now that I have that now, and then they're using maybe like a very simplistic SMS solution, and then they just send out the messages to everybody, right? And you hit that message, you say, that's not really relevant for me, but when there's a concentrate one, I will order. What I do and what my software actually does is assume the same pathway, but when we get to that point of deciding who gets the message of the deal, what I do is actually automatically segment within the customer base and find those who are of highest propensity to buy Flocana, or those who prefer flower, right? And basically get those and then send a message to them. And there we see very high, very good conversion rates because we're actually messaging what people care about. And to the point, you wouldn't receive a message until we have a concentrate deal on tap to be able to go after that. What I see more of is the former, where they just shoot whatever deal they have. But what people know that need to go to is the latter. And that's where actually I come in with my service is matching purchasers to their preferences, basically.
What does your crystal ball prediction say for next week? Are you going to expect a dip in sales this week leading up to the 420 deals and discounts? What I've noticed, having gone to 20 stores on 420 for the last 3 or 4 years, is that all of the 420 sales end up being the daily low prices about 2 years later. So in 2022, I expect your discount retail store to have 420 prices this year. Are you expecting a dip or a decline in sales leading up to 420, and what does 420 look like?
It's really good. I mean, COVID, everything's different, right? I would say before 420, I would have expected not a dip. I would have expected an increase up to, mostly because, and this is what I've seen in previous years, stores will hit the entire week. Right, they'll put so much money in their marketing budgets that week of, and they're just attracting a lot more consumers who didn't realize about the deals because there's just more advertisement out there. And then where you see the dip is after. Really, that's where you really see it really fall off, is like right after 420. You're not seeing as much because they stopped investing in the marketing, and they're not really focusing on the customer recapture from the new customers they got there, and they bought enough for 420. In the coronavirus world, I don't know. I do expect a pop. I do strongly expect a pop. I do expect that pop to be leading up before that. I think that's also very particular because of what day of the week 420 is. It's on Monday this year. So I expect Friday, Saturday, and Sunday to have a very large increase. Post, I'm not sure. I could see it going one of two ways. I could see a lot of people who around 420 who aren't regular cannabis consumers moving to cannabis because it's 420, because they do it every 420. It's their one time a year, but they're still sheltered in place. And they realize when they do that, oh, wow, like this is something I can consume at my house. Okay, that's an alternative to alcohol, which I've been drinking for the last 3 weeks and I'm bored of it. Right? And I think that massive shift of consumer behavior, the way that we saw this massive shift to consumer behavior on the delivery side, where now millions of people are aware of delivery when they weren't before. I think we're going to see the same thing with millions of people realizing that cannabis is a safe, is a comfortable option for them in their own homes. That therefore we actually might see this large increase of just total overall market usage post 420. I see a potential for that.
Man, time flies. I want to talk to you about so much more, but before we wrap this up, is there anything else that you want to show us?
No, I think this is a lot of what we got. Okay. I really enjoy talking about delivery, emphasizing the fact that delivery is, I think, a really key option. If you're a California dispensary, cannot encourage enough truly thinking about how to make sure your delivery offering is robust. And for other states, I think this is the future, to your point, like where 2022 is going to be. I really think a lot of it's going to be around this multi-channel usage of cannabis.
Definitely. I think there's a lot of, cannabis bills that are going to take the back seat. We've got a Class C felony on consumption. So it's a felony to maintain and operate a marijuana lounge. So while you guys have it in San Francisco and San Jose and some other places, we don't.
Yeah.
So I think that bill is going to take a back seat probably till 2021, but delivery will get fast tracked for this very reason. So some good things will come out of this. A lot of the pretenders will get out of the way. People that were altruistic, that weren't paying themselves, that, shouldn't have been in the industry. All those CBD middlemen gone, thankfully. Bye. So there's going to be some decent amount of opportunities, I think, with this pandemic, but at the same time, a lot of carnage. So it'll be interesting to see from a data analytics perspective. And I'd love to have you guys back on. Tell me a little bit about yourself and about Happy Cabbage Analytics and where people can find you.
Yeah, so Andrew Watson, I'm CEO and co-founder of the company. I come from backgrounds, technology, cannabis, analytics, finance. Basically, if there's numbers and there's data and there's a problem to be solved, I'm there. And if you want to check out more about what we do and what we can offer retailers and brands, you can go to happycabbage.io. And as I mentioned, if you're listening and you're like, hey, like I want to be able to enable my customers, I want to be able to communicate with them, I want to be able to recapture them, I'm happy to have a conversation.
Love that. And all those links will be in the show notes as well. So with that, we're going to roll this one up. I want to thank my guest, Andrew Watson. He's the CEO and co-founder of Happy Cabbage Analytics. Andrew, thanks for being on the podcast.
Thank you so much.
I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.